Well, let's focus on one of the latest debutants on the Lal Street, Zaggle Prepaid Ocean Services. Well, for the April to June quarter, the company's revenue saw a healthy growth of close to around 33%, but margins, they contract a little bit. Financial costs as well was higher. Mr. Avinash, the co-promoter, MD and CEO of the company, joins us on the show. Hi, Avinash. Good morning. Thanks so much for joining in. Well, tell us, what's the outlook for the year itself? You had given us some guidance earlier. Do you want to tweak it and do you want to revise that number?
Good morning. Thank you for having me on the show. So our numbers in the year, we are looking for about 40 to 50% growth on the revenue at about 11 to 13% of EBITDA margins. That's what it's looking like for this year, which is in line with what we had planned for.
Okay. Right. Just wanted a couple of more details from you, Avinash. The reason why your revenues grew was because of growth in customers and also your new product which you launched, Zoyer. But at the same time, there was a drop in gross margins due to a change in product mix. So wanted to know what kind of revenue opportunity do you have from a product like Zoyer, and what is a sustainable gross margin and product mix going forward for you?
For us, Zoyer is our latest launch, which is around accounts payable and vendor payments. If you look at a company, we are on the expense side of a corporate customer, right? So we do employee expenses, we do channel expenses, and we do vendor payments. And vendor payments is the latest addition. And in the vendor payments side, we are seeing tremendous growth. There's a lot of traction that we are getting on that side, because every company, if you look at it, has tons and tons of payments that they make to vendors. And vendor payments tend to be fairly predictable, right? Whereas employee and channel spends, if you look at it, there's always a seasonality around it. So you see a lot of, in our case, for example, our Q1 is typically about 15%, our Q2 is about 25%, 20 to 25%, and H2 is typically 60 to 65% of our revenues. Right? So the Zoyer product also starts to help us smoothen that out a little. In terms of the margin mix, of course, with our Propel Points, which is our rewards platform, our take rates there are higher. But the way Ind AS operates, when a corporate gives points to an employee, we recognize the entire points that are being redeemed. These are vouchers. These are points that are redeemed for vouchers. We recognize the entire 10,000 rupees. Let's say 10,000 rupees of points are being redeemed. We recognize the entire 10,000 rupees as our revenue. And let's say the cost of the voucher to us was 9,000 rupees. We recognize 9,000 rupees as our direct cost. So naturally, this business, while the take rates are significantly higher, our gross margins get impacted. But we expect these margins to stabilize over time.
Okay, got that. So your revenue growth, you hold it at 40 to 50% as you had guided earlier, and your adjusted EBITDA margins, you continue to hold between 11 and 13%. What kind of growth are you expecting in your customer base over the next, say, 12 to 18 months? What would the sustainable growth be?
See, growth every year, if you look at it historically, we've had about 600, 650 customers. We'll continue to grow in line with that or better. We also are focusing a lot on trying to, increase our cross-sell. And that's a focus area for us in the coming 3 years. So we are working on both levels, trying to get more traction from new customers, but also getting more stickiness and business from our existing customers. The stickiness has always been there. We are trying to understand how we can do more in terms of cross-sell with them.
All right.
So your corporate customers, currently you're sitting on a base of around 2,600, right? So yes. Where do you see yourself by the end of FY24 and 25?
I won't give a specific guidance here, but we've added, as I mentioned, in the last few years, about 600 to 700 customers every year. And we would be more or less in line with that guidance.
All right. Let's talk about your balance sheet, because we did see a fair amount of high finance costs, which you said that you will repay post your IPO proceeds. IPO proceeds have happened. What does your average cost of finance stand at right now? And as a result of which, in the second half, what will your quarterly finance cost look at?
So we've already retired about 47 crores now in our debt, right? And our finance costs are coming down because of that. and they'll continue to come down in the coming quarters for us, right? Because what we are retiring is obviously the higher cost debt first.
So what would the average finance cost per quarter be over the next 3 quarters or so?
I can't give you an exact number, but it would be lower than what it has been historically, significantly lower.
Okay, Avinash, we'll let you go on that note. Thanks a lot for joining in. Appreciate your thoughts. That is Zaggle. They're holding on to their guidance actually of around 40 to 50% growth.